April was a very difficult month for a lot of investments, as investors are still going to see broad losses in stocks and bonds. That's what you're going to see in your statements. This is a fact. It's usually you sell in May and go away, which, if you've never heard that, that's a very old strategy to avoid what were historically slower or more volatile months between May and November. But if you're a short term trader, you might have been very lucky to sell in April this time around for as bad as it was. Now, it's not new headlines, it's not new news. It's still inflation, a slowing economy, higher yields. It's still conflict abroad. These are the things we've been talking about, and they're all hurting stocks and bonds. It's not just one thing. Now, to be clear, I'm never going to advocate for trying to time the market. I'm just trying to share my emotion here. Even as a long term investor, I can get a bit unnerved by some of these short term moves. Even I need to remind myself of why we would diversify, even if it doesn't feel like it's working right now, and try to focus on the positive things we see happening and not just the negative. If you're absolutely fine to continue to trust the process, put your head in the sand, you're not stressed by these short term moves, congratulations, thank you, and you're welcome to turn this off. I promise I do. We do feel okay. And when we make some minor changes, if we do in the next couple days or weeks, we're certainly going to let you know as always. But I do want to get a little deeper into the weeds. And if you want to do that with me this morning, I welcome that. And I promise I'm putting on my optimist hat. I'm going to share 7 notes from LPL's research team that I think are very helpful to share, even if they get a little technical. So here we go. The first, it's earnings season. Companies have to report how they're doing every quarter, which, when you put it all together, certainly paints a picture that, of course, can drive stocks. Earnings season has actually been quite strong. Corporate balance sheets are healthy, and we the consumer, are strong. It's all suggesting that that feared R word recession may not come to be. Time's going to tell, but I'm sharing there's two sides to every coin, and I believe that if businesses and consumers are strong, that will move the market north again. Second, tied to that, though, are expectations. What can drive the market are expectations on those earnings. We expect Amazon to be making money. We expect oil companies to be profitable if we're paying 4.50 a gallon. We expect people are still watching Netflix. Just because Amazon had a bad quarter and maybe didn't meet expectations or weren't profitable, that doesn't make it a bad company, but it does move the market in the short term. And I want to remind you, these big companies like Amazon, Microsoft, Apple, Google, they're almost fair, it's fair to say they're disproportionately represented in some of these market indices. So when they look bad, it's certainly a bigger noticeable drag on the indice as a whole. So remember that. Third, it's sentiment. Speaking of expectations, sentiment is at a historical level of pessimism right now, which historically is really good from a contrarian point of view. And I think that's best represented by Warren Buffett's old advice, that is, you be fearful when others are greedy, and you should be greedy when others are fearful. So as the markets are trying to climb this wall of worry right now, might be a good time to have that Buffett contrarian view. Fourth, data. There's so much data, and not all the data hits the headlines. Big data point last week showed the economy slowed in the first quarter, which is now what drives some of the recession conversation. Now, here's the thing, the market and you too probably already knew this was going to be the case. We were aware of the COVID-19 variant that was the beginning of the year, and the drag on the economy that was trade, and the bottlenecks from supply chain issues. That was all over the headlines. So, in some ways, this should feel like old news. The key counterpoint is some of that underlying data shows momentum moving in the right direction, right? Underlying demand, as I said, from consumers and businesses were strong. That was seen in real final sales, which is a data point that rose an annualized 2.6%, up from 1.7 in Q4. That shows things moving across the finish line. And even if you don't understand that data per se, it does show momentum that growth could continue, and the idea of recession won't be reality. Fifth, we're still seeing inflation that's here. We're going to feel it. We're seeing it. It's why the Federal Reserve is going to increase rates again this week. They've told us they're going to do this. But should inflation peak soon, which, by the way, LPL feels is the case, I feel that could be a major driver for equity returns later in the year. It's not just LPL. The 10-year Treasury reaching 3% has been thought to be a potential peak, and we're just about there. Sixth, market movements. Yes, the headline shows that this is one of the worst starts to a year ever for stocks. The S&P is down close to 14% from its peak early in January. But here's the catch. Since 1980, the average intra-year correction from peak to trough is 14%. Incredibly, 12 of the last 21 times since 1980, the S&P corrected at least double digits. It actually managed to finish the year positive. So hope is not lost. Sell in May and go away. I'll end by circling way back around to the old adage, should I sell in May and go away? Well, history shows that yes. The slower months between May and October are worse than the months between November and April. But recent history tells a different story. Had you sold in May and gone away in 9 of the last 10 years, you would have been on the wrong side of that trade. So we should never fall into any biases as investors because anyone can make a positive or negative argument depending on how you carve up the data. So, what's the moral of the story? How should we handle this? We don't try to time the market, but we do consider rebalancing your portfolios when these swings happen. And we do look for opportunities where certain investments could be exchanged for others who may be better positioned for a rebound whenever that investment rebound occurs. So, remember, you've been here before. 14% swings are average in any given year. Trust the plan, try to be opportunistic when you can. And if you're feeling a little queasy, let us know. We'll chat about it.